Hey guys, what's up? I'm Adam. Today I'm going to go over 3 stocks you need to know, and right now no one can simply afford to miss out on profiting from these high potential plays. And what do I have my eyes on? Well, 1, a low float stock with a high short squeeze potential and a setup that reminds one astute Redditor of the GME short squeeze that we saw earlier this year. Number 2, a disruptive realty company whose volatile stock is trading 10 times of last year's share price and has way more upside potential in the weeks ahead. The last stock is a midterm play at a major discount with massive gain potential involving a new small streaming platform with an established global reach. If you want to make some money, then my friends, it is time for Clever Trades. Let's get into it. Now, I normally don't get too involved with stocks accruing interest via Wall Street bets or Reddit threads with hyperbolized sentiment, but this stock did manage to catch my eyes, and I've actually traded it back when it was trading as a SPAC, so I actually am pretty familiar. But before I get to it, please stop whatever you are doing and make sure to hit the like button, subscribe, and it's never a bad idea to hit the alert button as well so you never miss an opportunity. Let's talk about the ticker symbol CLOV, otherwise known as Clover Health. Clover Health is one of the many companies that's backed by none other than the king of SPACs, Chamath Palihapitiya. And as you can see, Chamath is actually no stranger to short squeezes. In fact, he, like many of us, is a pretty big fan. But this company faces a lot of risk simply to the competitive market. But over the past 3 years, Clover Health has managed to secure 25% of the market where it competes. And this is where the bearish argument ends. The total addressable market, otherwise known as TAM, was $270 billion in 2019 and is estimated to be $590 billion in 2025. As one analyst said on Seeking Alpha, CLOV's fair price value is around $31.45, and this apparently was calculated using a discounted cash flow model. Clover is quickly advancing market share, largely due to innovative software that actually lowers the cost while at the same time improves patient outcomes. In their investors presentation, Clover said, "Clover is quickly capturing share from its incumbents, and its differentiation will make it hard for others to copy." One thing that is not often mentioned by anyone in regards to CLOV is that most insurance providers have fenced off networks, meaning you only receive full coverage to certain doctors inside the health provider's network, with limited coverage received outside of the network. However, Clover's PPO provider networks are broad and open, and they enable its members to see any doctor participating in Medicare that's willing to accept them. But getting back to the topic of short squeezes, we see that Fintel, as of the date of this recording, has given CLOV a score of 70.17%. And this score is reflective of a high probability of getting short squeezed based on a collection of data like short interest, the number of shares borrowed, borrowing fees, etc. And out of more than 6,000 stocks that Fintel has scored, this is still relatively high. And I like to pair higher than average short interest with the overall interest sphere of traders. So let's take a look at the overall interest in this particular stock. On Reddit, speculation and individual due diligence has been accumulating for a couple of weeks. And when looking into plays like CLOV, you're bound to find a YOLO or two. And seriously, I really hope this guy has a plan, because that is a lot of dough just to sink into a play. But seriously, if you were to observe the social interest, and let's say the ticker symbol AMC, and let's say you look at the stock to its number and you compare it to CLOV, and you might conclude that AMC had potentially more buyers. And that might be true, but I can tell you with more confidence that AMC has far more bag holders. AMC already saw a moderate squeeze earlier this year when GME mania was in full swing. Borrowing fees are insanely high here, so there is still potential for a mega squeeze to break out, since brokers who are lending shares here believe the risk for short selling is extremely high. But as old adage says, the trend is your friend. The search trend, that is. And search trend reveals another interesting point. AMC has been trending down for a while, except CLOV has not. Interest in CLOV is still high in relation to daily search volume, but ultimately my intrigue was piqued with what one Redditor pointed out recently. They noticed an extremely high number of active call contracts with a May 21st expiration date. This number, in fact, is higher than the active number of call contracts before the squeeze happened with GME. And what he's pointing out is the potential for what is called a gamma squeeze. So when you have a pretty high concentration of short interest, and by normal metrics, anything above 20% short interest is high, you just can't use GME's short interest as a comparison because that was a very rare instance. But the high concentration of call contracts will drive the price of a stock upwards. And as the stock price moves upwards, typically traders will purchase more call contracts. And that pushes the price up even farther. And as a result, short sellers will go berserk and even try to short the stock further. Or if they're smart, they'll cover their greedy butts and they'll buy shares back at a higher price than the price they shorted. The result is a gamma squeeze. It's a beautiful sight for sore eyes and empty wallets. I'm targeting at least $14 to $16, and there's no guaranteed chance of the stock hitting that price target. So don't go all in and manage your own risk accordingly. And as more attention is given to CLOV, and I do see that short interest is likely to increase along with borrowing fees, a squeeze could in fact happen sometime in the next couple of weeks. Now let's move on and discuss my disruptive realty pick, and that is going to be ticker symbol EXPI. Now EXPI belongs to EXP World Holdings Inc., which houses the company EXP Realty. So guys, if you're not aware of what's been going on around the country, and I'm not talking pandemic, although that's largely affected this industry, let me tell you why I think ticker symbol EXPI might just be one of those epic plays that you just can't miss. You see, homes are selling at a lightning pace. In some areas, sellers are picking the highest offer on their home after only 24 hours of listing it on the market. And they're not just going for a few thousand over asking. In some places where inventory is extremely low, they're going for 50 to 100,000 over asking price. So here's my thesis in a nutshell. When you consider eXp Realty's growth rate and the state of the housing market plus its implications on poor future prospects, I mean, just think of all the bidding wars that are going on right now. I do believe that EXPI is undervalued. As of March 30th, eXp Realty has added 50,000 agents globally, and they expect a presence in 16 countries by Q2. With that amount of agents selling overpriced inventory 50 to 100,000 over asking to willing prospects, the results of their earnings should be in line or exceed growth expectations for Q1. They have an extremely consistent track record when it comes to revenue growth. They've beat their revenue every single quarter in the past year, and in Q4, they only missed on earnings by 3 cents for the year 2020, and revenue grew by nearly 80%, $159 million in profit in 2020 compared to $84.1 million in 2019. And home buying demand, which typically slows in winter, accelerated this year up 60% according to Redfin in January of 2021. And the forecast for the number of homes sold in the US in 2021 is expected to rise by 15%. Whereas in 2020, which is undoubtedly a record year of growth for eXp Realty, home sales only rose by 5%. Year over year. Between 2020 to 2021, there was at least a 4% increase in the average price of homes, and buyer demand is expected to remain high near term. EXPI's current as-of-writing valuation shows an adjusted forward earnings multiple of around 114, which some analysts say is high in comparison to the sector. However, as one analyst says, one of the more meaningful areas we can look at is its sales-based valuation on a relative basis. If you look at the company's enterprise value to trailing 12-month sales ratio of about 4, it compares very favorably with the sector median of 11.4, which indicates that the stock is actually trading at a huge discount to its sector peers. Another multiple to look at is the TTM price to sales ratio. EXPI's multiple here is also around 4 against the sector's median figure of about 6.3. Another indication of good value. Now, getting into technicals, when you look at the chart, you can't help but notice the insane rally after Q4 earnings were released on November 9th, 2020. Even after hitting a peak of around $80 and dropping nearly 50 points where it is now, it's still trading at nearly 10x of what its price was a year ago. So I was hoping the stock would hold support last week. Because my stop loss was set at $35, I'm looking to re-enter as I see solid support. At least 2 analysts at the Wall Street Journal give an average price target of $71. Q1 2021 is a crucial period for showing that their top line revenue has continued. If you are trying to play the stock in, let's say, in the short term, please don't. It's never a wise idea to play earnings with a short-term trade. And if you are patient and can wait 1-3 months at most, and you believe in strong fundamentals, then you will not have a hard time believing that this next play is a huge winner. My global small streaming platform pick is none other than the ticker symbol DISCA. But getting into it, during earnings last week, Discovery Inc. posted a net income of $140 million, or 21 cents a share, down from $377 million, or 55 cents a share. But revenue rose to $2.79 billion from $2.68 billion a year earlier. The company finished the first quarter with 13 million direct-to-consumer subscribers on a global basis and now has more than 15 million paying subscribers. David Zaslav says key metrics including subscriber additions, customer engagement, and retention are exceeding our expectations and demonstrating sustained momentum into the second quarter. And that's what's important to pay attention to here. You need to realize what Discovery's CEO is saying. He's saying you haven't seen anything yet. And lifetime value is huge in a recurring revenue business. And if retention stays high, streaming is going to put far more money in their pockets because they're going direct to consumer. And then you factor in how they were not able to properly monetize a platform with advertisements, but will now be heavily focused on ramping up advertiser relations. You should absolutely expect earnings per share to rise if Discovery plays their cards right. And for the longest time, the biggest issue investors had with Discovery is that for all its content, it has struggled to get all that content into households. That's all changed now because of their streaming platform, Discovery Plus. Let's look at the technicals, and I'll talk more fundamentals in a second. You can see the massive sell-off here and a classic falling wedge. The sell-off was largely due to Archegos funds liquidating large stakes in stock like Discovery and Viacom. That type of selling pressure that you can see here in the candles is insane. It breaks out of the downtrend right where we see it in the range of being oversold on the relative strength index. We're still technically in the breakout, so it's hard to say at this point whether we'll see a continuation of downtrend or if this sideways action is going to attract more buyers. I mean, this is one of the best deals on the market, for crying out loud. I'm personally targeting $46 midterm, and I believe there's more upside from there. I'd wait to see if the stock holds support, which at this level is around $35.41. This could take a couple weeks to gain some momentum, but I'm extremely confident in this play, as I've said. Getting back into fundamentals, there is almost no barrier to entry for consumers. I mean, look at this, $4.99 a month with advertisements and $6.99 a month without advertisements. That is cheap, you guys, my goodness. But you know investors, so I can see some of them having an issue with this low cost, deeming it unimpressive at face value. And despite the lower cost of Discovery's content, its 55,000 plus episode library and immensely strong brands in niche areas is going to be insanely difficult for any competitor to surpass. But streaming platforms are springing up everywhere, Adam. Everyone knows this. And that is true, but there's also plenty that haven't survived being a startup, and Discovery Inc. already has global reach established, unlike many of them. Yeah, but you know, some states loosened their restrictions, so less people at home, sure. But in December, the average number of streaming services per household increased from 2 to 4, while the average monthly spend increased to $47 from $38 per month last April. And there's no doubt in my mind that we're reaching a new equilibrium. You and I have a lot of choices. If you're like me and you don't want to spend hundreds of dollars on subscriptions, that means we are always going to want to narrow our choices. And as streaming becomes more of a substitute rather than a complement to cable, streaming platforms will increase their prices. All it takes is one individual in a house with strong interest in a particular genre, be it food, nature, home improvement, etc., and they're going to subscribe to whichever service suits them best. And rather than having something for everyone, dominating in genres that cater to niche will absolutely work for smaller players. And this is what Discovery excels at with 4 of the top 20 most watched cable networks: TLC, HGTV, Discovery Channel, and Food Network. I mean, come on guys, Gordon Ramsay here, Hell's Kitchen. There's a lot of good stuff on there. You see, 93% of their massive library has been watched. That tells us that people really like what they produce. I mean, come on, that's an crazy level of engagement. And Netflix can't even touch that type of engagement. Now, Discovery maintains ownership rights of global and local IP that they own and retain global streaming rights to. And it's very positive to cash flow, considering they just simply license their content to platforms like Delta Air's onboard entertainment platform. They have 108 million plus cumulative social media followers. Now you can compare that to Netflix, 74.7 million, Disney Plus's 53.5 million, and HBO's 12.7 million. And perhaps the biggest differentiator that Discovery has going for itself is the low cost to produce content, which cost about $400,000 to produce versus $5 million for scripted, which adds up to $3.2 billion for the 8,000 hours of original programming that Discovery delivers per year. Netflix spends around $17 billion for its content per year. Now guys, I'm not saying that Discovery is in any way Netflix. After all, Netflix has produced some pretty awesome cinematic content, but it all comes at a cost that is insanely expensive, and Netflix isn't even cash positive and won't even break even until after this year. So in other words, Discovery is quite undervalued. Lastly, they've acquired 15 million subscribers, and management has already said they don't even need a crazy number of subscribers given its higher gross margins versus scripted entertainment. And I don't think there's room for anyone to object to that. So again, this is a midterm play for me, potentially 1 to 3 months out. That's where I think we're going to win. I'm targeting around $46, which I believe at current market levels is fair value. If you made it this far in the video, thank you so much for your dedication. I'm throwing a bonus play your way. This is a play with potentially 23% upside. I've even noticed politicians like House Representative Dr. Mark Green buying shares. If politicians are buying shares, you know there is legislation on the horizon or some societal catalyst that will influence the price of shares in the future. And these guys know about it typically before we do. Now get pumped about this oil energy stock, ticker symbol MPLX. Out of all the stocks I have traded this year, few compare to MPLX in terms of financial stability. During the first half of 2020, adjusted EBITDA remains almost untouched. That's evidence of cash flow resiliency, considering that Q1 and Q2 should be characterized as one of the worst periods it has ever seen for the energy sector. The company delivered a full-year EBITDA of $5.2 billion, $100 million higher year over year, which is insane considering the pandemic and horrible cash flow forecast for many companies in that sector. And with talks of a gas shortage that I've been hearing, that means this company should benefit tremendously from demand. Lastly, the overall P&E of the oil energy market is around 83, and MPLX shows a P&E of 10, which shows the stock is considerably undervalued in comparison to its sector. Now, I'm targeting $33, and there is definitely room for more upside. Now, if a gas shortage is to occur, you can bet to see this energy sector red hot. And guys, that's a wrap on what I have to say to you today. In the week ahead, I hope you kick some serious butt. Make sure, if you haven't already, subscribe, like, and turn on notifications so you never miss any money-making opportunities. As always, manage risk, avoid stupid, and trade clever. Happy trading, everyone. I will see you next time.